Hello there and welcome. Quickly in this video, I'm going to be sharing with you a few tips how to reduce your tax liability as a corporate entity or as a company, alright? Registered with the Corporate Affairs Commission if you're in Nigeria. Of course, there are new tax laws that will take effect from this year, January 2026. I just want to bring to your knowledge these few tips that will help you reduce your tax liabilities to the barest minimum. In my previous video, I talked about how to reduce tax liabilities for individuals and employees. So quickly, I'm going to be sharing for corporate individuals in this video, right? So let's dig in. Welcome back. Now, as a corporate entity or as a company, the first tip you need to reduce your tax liability is to first of all get acquainted with the tax law. Yes, you heard that right. You must get acquainted with the tax law, read up the provisions of the tax law so that you can get knowledge on how to navigate these tax laws that are taking effect fully, so you can know where you belong and where you stand. Alright? But quickly, tip number one. Now, this tip is going to small companies. In the previous provision, if you are a small company and your gross annual turnover was 50 million or less, you were exempted from tax. So a small company, by the provision of the previous laws, said if your annual gross turnover was 50 million naira or less, then you are a small company. But in this new provision, it has been increased, meaning you have more room to generate revenue and grow your business, which means a small company by the new tax provision is defined as a company whose annual gross turnover is 100 million naira or less. And also, if your total fixed asset, the value of your total fixed asset does not exceed 250 million naira, that is, the total value of all the assets you own as a small company must be 250 million naira or less. If you satisfy these two conditions, then you qualify as a small company. Your annual gross turnover must not exceed 100 million, and the total fixed asset you own that you use to run your business, fixed asset alone, should not exceed 250 million, then you qualify. Now, what does it mean? If you fall in this category, you are exempted from tax. So you should be aware, because in the former provision, you won't be exempted from tax, but now you are fully exempted from tax because you are known as a small company. Alright, tip number two. Now, if you are a company that your real business is real estate, you are into real estate, with the provision of the new tax laws, you are going to be paying a higher tax called capital gain tax. In the former provision, it was 10%, but now it has been increased to 30%. Meaning, if you sell your properties, or as a business or as a homeowner or as a real estate company, you are going to pay 30% of that proceed of the sale of that asset, called capital gain tax. What does it mean for you? Now, how do you avoid paying capital gain tax? Now, as a company, to avoid capital gain tax, simply when you make a sale of a property, alright, it is advisable financially that you use the proceeds of that sale to refinance another property of the same class. Because the law gives you 12 months to use the proceeds to buy back another property of the same class. Or else, after the expiration of 12 months, you're going to pay 30% as capital gain tax. So how do you avoid it? Listen, use the proceeds of that sale and buy back another property of the same class. Yes. Then use that property you bought as a collateral and take a loan to finance your business. Because when you finance your business by debt, you pay zero tax on that debt. So the loan you have gotten, you can use it to finance your business. And the interest you're going to pay on the loan will be way smaller or lesser than the tax you would have paid on that property. And also, this is for owner-occupied home. If you're living in a house and you sold the property, the interest you pay on mortgage on that house is tax deductible, meaning you can deduct it from your income before tax is charged on the remaining balance. Alright, so that's it. But for corporate individuals who your business is real estate, to escape paying capital gain tax of 30% of your proceeds, it's better use that money within 12 months, refinance another property of the same class, then use that property as a collateral and get a loan and use it in your business. However, there are exceptions to the real estate companies that can pay this capital gain tax on sales of property. So like we said, the intent for the acquisition and holding of such properties will now be the basis to determine the type of tax that will be paid. Alright? So the intent, why are you buying that asset? Is it for capital appreciation? Is it for rentals? Or is it to develop and to sell? If it is to develop and sell, definitely you're not paying capital gain tax, you're paying your business income tax, because sales of properties form your basic business operations. So they will treat that as your inventory. But if you're buying properties for banking, for land appreciation, or for rentals, you are going to classify under NHIS 40 investment property. In the event where you want to now sell those properties you are giving for rentals, or those properties you have held over a long period of time to appreciate and you sell them, you will transfer them to another provision called IFRS 5, non-current asset held for sale. Upon that provision, you are now going to sell them and pay your capital gain tax. So the intent of such property acquisition and holding will now be the basis to determine the type of tax that you're supposed to pay. Right? So buying such properties, your intent should be clearly stated in the evidence of payment and all those documentations, right? So that it will be used as a yardstick and the basis to determine the type of tax you pay as a corporate entity. So if you are a real estate company and you are into property development and sales, those assets are now your inventories. So they form part of your basic business operations. What will apply to you is IAS 2, that's inventories, because your land, your building, your assets are now your basic business operation. They are your inventories. So the provisions of IAS 2 inventories will apply to you. So you will not pay capital gain tax, rather you will only pay your corporate business income tax. Right? So stay tuned. Let's go to tip number 3. Tip number 3. This is very important as a corporate entity. Of course, you will need an accountant in your organization to help you with this. So if you are a fresh company, you want to start up, it is advisable you hire a qualified accountant who will start keeping your record ab initio, from the beginning. Because all the assets you're going to buy should be clearly stated in a book called Fixed Asset Register. Alright? You have it stated, the receipt of payment, the evidence of payment, all those documents that you show that you bought those assets. We call them qualified capital expenditure. Now, why do you need an accountant? Because he's going to document these properties for you and use them to apply to the Federal Ministry of Trade and Industry when you'll be given a fixed asset certificate of acceptance. It's called FACA. From that ministry, that certificate will be used as a yardstick to qualify you to make that capital expenditure, which in turn will help reduce your tax liabilities. This is called capital allowance. Now, with you buying those qualified capital expenditure, those assets you're going to use in your business, and having gotten a certificate from the Federal Ministry of Trade and Industry to qualify that yes, you were authorized or such asset qualified to be used as an asset in the business, you'll be given a certificate. With that certificate, you can use it to claim your capital allowance, which will reduce your tax liabilities as a corporate entity. Alright, so this third tip is called capital allowance, which you have to claim on qualified capital expenditure you make in the business. So in the new provision, the tax laws have said an asset must be wholly and exclusively incurred for the purpose of the business before it will be tax deductible. In the former provision, there were 4 clauses. It must be wholly, it must be reasonably, must be exclusively and necessarily required before that asset to be qualified as a tax deductible expense. With the new provision of the law, the government wants to make it less litigative. They want to reduce more arguments and less litigative for companies. Alright? So they remove two clauses as okay, if an asset is wholly and exclusively incurred for the purpose of running a business, that asset will qualify to be used as a tax deductible expense. Right? And of course, you will need an accountant to do this, because an accountant will help you document your fixed asset register in a book, because you will need that document whenever you are applying to the Federal Ministry of Trade and Industry. They want to see your fixed asset register, the evidence of payment, the receipt, the date they were bought, the cost at which they were bought. And then they will now determine, okay, so asset is necessary for you to use in your business to generate revenue. But this one doesn't qualify, this qualifies. They will now determine, at the end, they will issue you a certificate called FACA, Fixed Asset Certificate of Acceptance. With that certificate, you can now use it to apply to the tax authority that you have incurred a capital expenditure. Therefore, you should be given a capital allowance. Alright, so I won't go to details so much in this class. Right? This is not an accounting class, but I just want to give you a heads up that there's an allowance called capital allowance that every company registered in Nigeria should claim. Many companies don't claim this because they are not aware. And number two, they don't have professional accountants in their organizations, or they don't even have accountant that they consult. Right? So please, you must have an accountant that you consult as a business. If you want to start a business, you must have a lawyer, have an accountant, right, that will help you keep your financials intact. Right? So they will help you do the process of the application, gather your fixed asset register, take the document, apply to the Federal Ministry of Trade and Industry, and then upon verification, you'll be given a certificate. With that certificate, you can now use it in your tax filing to file that your tax should be reduced because you have incurred qualified capital expenditure. Like for those of you in the agricultural industry, the government gives you 5 years that you not even pay tax. If you're in the agricultural sector, animal rearing, crop production, food production, 5 good years for you to now start paying tax. They call it tax holiday. Right? For those of you who want to start a company and you want to pay lesser tax, go into an agricultural company, start food production. After all, food is one of the necessary needs of man. We'll never stop eating until we die. So go into agriculture, you have tax holidays, you have a lot of relief from the government. Some of the qualifying expenditures will now be enjoyed fully. Another tip I want to bring to you is called research and development. Now, with the provision of the new tax laws, companies are granted up to 5% of their annual gross turnover for research and development. Of course, you must prove that those expenditures or research you are engaging relates to your business activities. Alright? So that's it. So you can even claim up to 5% of your annual gross turnover for research and development. So engage in those research. Maybe you're trying to develop a product. For those of you manufacturing companies, develop a product or invent new product or services. All the money you spend for research and development is tax deductible, up to 5% of your annual gross turnover. Alright, this is another tip to reduce your tax as a company. So you should also keep detailed record of any money you spend or expend on research and development. Your accountant should keep detailed record, alright, with verifiable evidence. You can use it as a means to reduce your tax liabilities. Alright, final tip. Please pay attention to this tip I'm about to share now. Now, this concerns companies with employees. Right? Now, the provision of the law has granted you that deductible expense up to about 50% of the benefit you give to the employees. Alright? In addition to the withholding tax, withholding tax, that is called payee. Withholding because you're going to withhold that portion from the employee's salary to remit to your Board of Internal Revenue or to the Federal Revenue rather, or the Nigerian Revenue Service, which has been changed. Since you're going to deduct payee, it's called withholding tax because you're withholding it from employees' income, from the source. Any income you hold from the source to remit to the authorities is called withholding tax. Right? Now, as a company, you are going to withhold employees pay and remit. Now, all the benefit you provide to the employees, even the new employee that you just employed, when you increase salaries, all the payments, your benefit you're giving to your employees are tax deductible. Don't be scared to have a good name or good face before your employees. If you increase their salaries, you can deduct it from your tax. So right now, by the provision of these new laws, companies can claim up to 50% of salary increase. You give wage awards to your employees, you give them transport subsidies or transport allowance to low-income earners who earn low income in your company. Those low-income earners must not earn above 100,000. If you give those kind of people transport allowance, you give them wage increase, alright, or wage award or bonuses, it is tax deductible up to 50% of it. Also, you are going to claim another 50%. So a 50% deduction is allowed for employees who have stayed in the company for 3 years, not less than 3 years. You have just hired an employee and they stayed for 3 years. You can deduct their wage increase up to 50%. It is tax deductible to reduce your tax liabilities. Also, the contributions you make, because for pension, your employee will contribute 8%, you will contribute 10%. That 10% is for pension you're contributing is tax deductible. The contribution you're going to make for National Housing Fund for your employee, for National Health Insurance Scheme, pension, all those recognizable PFAs, contributions you're going to make, they are tax deductible. So why not provide your employees all those benefits and at the end claim it from the government so they can have a good name and a good face for your employees? It helps you retain good staff in the company. So instead of, if you don't pay, if you don't make those contributions, National Housing Fund, pension, housing scheme, you will pay those things to the government and you have poor employees because you don't take care of their welfare. Alright? So make those contributions, 10% for their pension, 2.5% for their National Health Insurance Scheme, 5% for their housing. Make those contributions. It will help you retain good staff. Right? Because most times when we do social accounting, we judge the performance of a company, we check the rate of turnover of their employees, how long do they stay. A poor company is judged by how often staff leave the companies. Right? So it makes you a poor company. You don't have a good name outside the organizations. Right? So make those contributions to help you retain good staff, reduce your rate of staff turnover, because the company with a high staff retention shows that the company is doing well in terms of social responsibilities, even to their employees and to their stakeholders. Right? So make those contributions, don't be scared, because if you don't make them, you will pay them to the government. That's the fact. Give them those contributions, give them those allowances, contribute to their housing fund, contribute to their pension scheme, contribute to their health insurance scheme. They are all tax deductible expense. Alright? Those are the few things I just want to bring to you today. Alright? So please go ahead, show us some love, subscribe to our channel, help us grow so that we can keep bringing you relevant information that will help you stay liquid as corporate entities and as individuals. Thank you for watching this video and bye for now.